Hello and welcome to a brand new show of Market Makers. The union budget is history, event risk is behind us, and bulls have made a roaring comeback. For a change now, both locally and globally, the bears are running, and the bears are running with tail between their legs. So are the bulls back? And if they are back, are they here to stay? What about global considerations? And is the worst of the print for this year behind us? Let's discuss valuations, market positioning, market behavior, sector and themes with a market veteran who needs no introduction, Jayakumar of Prime Securities. So good to have you back.
Thank you.
You've been hiding for over 2 years now.
Not hiding, doing my own work as it were. No, not really. I mean, since one has been sort of working away, as I said, in the spaces that one understands, which is the corporate finance space. So clearly there, but you can never get away from the markets. Markets have been there. It's just that you're not in the sort of broking and the sort of publicly more visible sort of public
television channels. Let me put it this way.
Television channels, a good way to put it.
So good to have you back, and
thank you.
It's good to see that bulls are back, but are they here to stay?
I think the way you should put it is not the question of bulls being back. I think if you go back in time to 2014 and the way this entire thing, when the government came, literally every channel had 100% consensus amongst people who came on that they were long-term bullish. Most of them said they were medium and short-term bullish as well. So there was nobody virtually on planet Earth who was not bullish about India, and for good reasons, right? Because so expectations were built up, the markets kind of made new high and so on and so forth. But the interesting thing is that if you see over a 2-year period, the weighted average, the index has ranged between 7,800 and 8,300, 84. That's where it has spent, should I say, the most amount of time. So if we go back and say consensus bullishness, everybody bullish on the market, everybody make money? Clearly the answer is, you've had a 2-year, what I would call a distribution phase, where the markets have sucked people in and kept distributing in a sense. SIPs have come in, public has come in, institutions have come in. And guess what? The market at the end of 2 years has made a new low.
Exactly.
So it just shows how consensus fails. And when the 7,800 or 7,700 signposts started dropping away, that's when the last fall was as vicious as it has been. And it clearly tells you that consensus doesn't pay. And for the first time now, especially over the last 2 months, you've had a fair sprinkling of people who are pessimistic. Calls of 5,500, 6,000, 6,200 have abounded on the streets. And you've had, to an extent, a great deal of disenchantment with what they felt the government could have done, missed opportunities. Those are the standard phrases. So the last 2 months have been littered with a capitulation by the bulls. It's not been one day, it's not been the sort of theoretical, the technically perfect capitulation, if you will, but essentially people have surrendered. Those who are sitting on, typically if you see the large market participants who have a fair combination of the futures and delivery, have let go the futures positions. People have gone back to saying, let's take my hits, let's move out. The biggest names, and we don't need to get to this thing. So you've had what you would call a perfect capitulation over a 2-month period, where people kept getting out, and it's been the highest amount of stocks being borrowed internationally and being sold into the Indian markets has been the highest ever. So the P-note guys have been lending stocks out and hedge funds have been shorting away. And it ended in a kind of a selling climax, with the budget for most years being a pre-budget rally, this time being a pre-budget collapse. So I think it was in that sense a perfect, and from what I understand from some of the charters, that 6825 to 6900 was the perfect correction bottom. So my own sense is that it's made a great bottom. It's flushed a lot of people out. And the best part is the channels continue to report that every rally is a sell-on rally. You take the 4 or 5 business channels, 90% of people who come on the charters have been till 2 days ago saying it's a sell-on rally. Now for the first time in the market, with like greased lightning has taken away some of the 71.25s and the 72.50s, and suddenly now people are saying, hey, you know what, the trend may have changed. So it's early days. We're into the first few days of what I would call a trend change. But I think if you ask me, perfect time when bulls have lightened up, bears are in full control, have been in full control till recently, and hope has given way to almost near despair. And as I keep saying, when there are no reasons for a market to rally, that's when the market inevitably rallies.
Bull markets, they always climb wall of worry, and this time there
absolutely.
are a lot of worries. So there are two risks to any market. One is the valuation risk.
Sure.
Second is the emotional risk.
Right.
The emotional risk, I think, is there. What about the valuation part?
It's not whether 15 PE is good or 17 PE is not good. It's not as much as that. It's all about fund flow. Fund flow changes perceptions. Fund flow changes moods. And people used to say that when oil came down, let me give you a parallel here. Everybody knows that when 120 came down to 30, logically it's very hugely beneficial for India. So who's benefited from this? Who's benefited is very simple, the government largely, because they've used up most of this fall in terms of shoring up the excise duties, and therefore the fiscal math of 3.5% or 3.9% for this year is largely on account of these huge indirect tax collections. Who's lost out?
The consumer.
Well, consumer to a large extent in terms of spending power, but more importantly, the oil-rich sovereign funds, from their perspective, every barrel of oil they sold at $80, $90, $100, the surplus they deployed in the markets. So when it's like a typical HNI trader, when he makes money in the F&O, the profit he uses for buying delivery. On the way down, when the F&O trader loses, he sells his delivery, which is why there is this confluence of markets coming down and going up, right?
A lot of that has happened this year.
Exactly. So what happens is it would have been balanced had this entire thing been given to the Indian trader in a sense, and the money, but there's been no countervailing force for the sovereign fund sell-off, because on a daily basis 80 became 70 became 60 to a point where he started imposing taxes on his local public, as you know, many of the Middle East countries are doing. It means he has to generate that from somewhere. He sells his fund of funds, he sells his direct exposure, he sells his indirect exposure, and that has directly impacted in the FI sell-off. So that unfortunately has not got counterbalanced by local buying, because the entire surplus went to the Indian government from its 3.9% to 3.5% fiscal math. So really speaking, the market lost out on this entire flow of 1.5 lakh crores or whatever we're saying. A large part of it we lost out because we just lost out the delivery stocks which had to be sold by these big funds. Which brings me to an interesting point. So what is the right price?
What is the sweet spot?
What is the sweet spot of oil? At which point we are indifferent. So my own sense is I used to feel that the day oil crosses 36, between 36 and 40, the selling will stop, which seems to have happened. Above 40, you will actually start seeing, small buying come through. But between $50 and $60, where the government doesn't have so much surplus, but more importantly, they don't have to sell their investments. In fact, they can start redeploying. Because for most people, oil still is in the 10s and 20s in terms of pulling out of the ground.
Old oils, depreciated assets.
Right. So at between $50 and $60, the flow into the Indian markets will continue. They will not have to pull out. And guess what? The consumer gets his petrol at whatever price, diesel at whatever price, and the government doesn't have that spare thing. So government has to do other things than depend on excise. So to my mind, strange as it may sound, a $20 oil is not a great, because it's between 50 and 60. So actually, the way I look at it is, with the dollar index in a sense topping out, I think you're going to have commodities moving up. And I'm actually hoping that oil moves into the 40-50 range, maybe even to the 50-60 range, at which point a 40 to 60 range gives enough funds into the Indian markets without disturbing the fund flow. Otherwise, you're going to have this wall of selling continuing. And unfortunately, all of the SIP is getting consumed in that.
Let's talk about a very important concern, and the concern for global market watchers is the deflation fear.
If there is surplus in the world, I think the logical question is, I don't see a deflation fear because I think the US growth is back. If two economies in the world are coming through, my own sense is that I think there will be these pockets of growth that will come through. I think China too, maybe the fears are overstated. People felt that the weakening of the currency may be one way. I don't think, there's been a sort of cap put on that as well. So somewhere along the line, I think there is an uncertain calm coming through, but there are pockets of calm which is indicating to me that maybe these fears are overdone. Also, I'll tell you one thing, we should not underestimate the impact of market moves on policymakers. Because for the first time, you had Yellen repeatedly talking about market volatilities affecting her policy making. So really what's happening is there are crowded trades in different parts of the world. Those crowded trades are putting disproportionate pressure. So as more and more banks get out of things like derivatives, every time there's a problem, we talk about, the trillions of dollars of derivatives that, let's say, a Deutsche Bank holds, and there are WhatsApps sort of doing the rounds as though people never knew this earlier. But one good thing is that as banks in the world more and more come out of these derivative and complex derivative products, there is a calm that is coming through, which was actually created by an overabundance, if you will, of crowded trades and the markets in a sense putting pressure on economy. But the real economy at many times kind of loses its touch with because of the the pressure of derivatives, if you will. I think to the extent that the Indian government and its more traditional approach towards inflation shows that the currency can be stable, indicates that maybe there are parallel tracks that can work. As far as this is concerned, I for one believe that the hiking of rates in the UK, in the US, actually would be a greater incentive for for markets to move up than to say that we'll continue with this quantitative easing forever.
That's a signal that the Fed is very confident in this kind of an environment that markets can absorb a rate cut.
Except that I'm saying they're doing this despite turbulence, which at some point is easing off worldwide. So I think we should not run away from the fact that while everybody says, today the flow of information, the flow of this thing through channels or through just the spread of the internet, social media, etc., is so much that virtually the moment there's a problem in one small German bank somewhere, literally somebody in one corner of India will know about it, literally next second. So I think fears tend to get exaggerated. I think concerns tend to get overblown, and at the same time, euphoria and despair tend to get magnified.
The market cycles are getting shorter.
And they're getting shorter. So volatility. So we are living in a world where volatility has gone up, but I think we can't run away. You talk about valuations. I have not ignored that question. I think valuation has to be stock specific. I think gone are the days when I say auto sector and I say that Maruti, Tata Motors, Hero Motors and Bajaj will be painted with the same brush. It can't happen. But when there are index based sell-offs, they all come down the same way. Mid caps come down far more, frontliners come down probably far less because of the fact that there are more buyers or whatever at lower levels. But the fact is valuation now has to be stock specific. Given the flow of information and research coverage, my own feeling is this more than ever before is a market for stock pickers.
So where are you picking your spots?
Okay, one can sort of go along. So in the frontliners, for instance, I think clearly, there is a lot of play on the PSU banks. I think I for one, again, and there are different spaces we can, I'll walk you through, but PSU banks, I think, have just been crushed beyond belief because there's been a fear of unlimited dilution. So the exact parallel being the TARP in the USA, when, for instance, Citibank went from $48 to $1, and the government said, don't worry, we'll bail you out at $50 billion. So
minority shareholder got
just disappeared,
shafted.
right? They got shafted. So now here, the fear of unlimited dilution, right, has kept these things under pressure. Now you had one Bank of Baroda coming and saying, you know what, we don't need government capital. So there's somebody who actually stood and said, you know what, I'm a custodian of the small shareholder and the retail shareholder in this. And people said, you know what, there's somebody actually looking after our equity interest in banks. That resulted in a disproportionate move in Bank of Baroda for starters. But now you have Basel III norms coming through. So little snippets of that indicate you can take some real estate, mark-to-market gains, etc. So now the need for capital will be questioned. I also think that, not enough can be said for the kind of, history will bear me out, I think, when they look back and say what the Reserve Bank under Governor Rajan has achieved. I think it's incredible. The clamping down on, let us say, delinquent borrowers, the clamping down, the rules and the recognition, etc., has forced banks, ably supported by what the government has been able to provide in terms of going after delinquent borrowers, going after...
there is accountability. I mean, now you have to call a spade a spade. You cannot call a spade a jack now.
Gone are the days you go to Delhi and get your loans approved, which used to be the sort of common...
Systems and processes are in place.
No, I mean, forget Delhi. You have to get to banks. And today the banks are asking questions of borrowers that have never been asked. And thanks to, as I said, the RBI, thanks to the government for clamping down on one. Number two, the pressure that the governor and others have put in terms of recognition of these accounts. That's the next thing. So it used to be a black box. Now you're saying, wait a minute, forget the black box. Now you start accounting for it. So you have again, as I said, one Bank of Baroda, one SBI coming and saying this quarter, next quarter, we'll clean up everything. Baroda has actually said we're cleaning out everything in Q3 itself. So I think for the first time, there is some clarity. And markets are realizing that they may have painted this, too negatively with a black brush, as it were. So I think PSU banks offer a great degree of hope. And one or two more banks come and say, we've got our act together, our gross NPAs are under control. I think the next phase will be the recoveries. And my own feeling is today, we deal with a lot of restructured accounts. We do a lot of restructuring as part of our corporate finance. Today, let me tell you, large borrowers are running scared because this entire social unrest almost.
Nobody wants to be called an NPA, let's be real.
Willful defaulter, we don't know where Supreme Courts will opine as to what should happen to willful defaulters. Today, there is a fear that the clamping down could go the other extreme.
So your thesis is that banks have been aggressive on the NPAs and the write backs will happen and book values will move up.
And I think this cycle will reverse itself a lot because remember, bank is the ultimate leveraged play. As these start coming in, suddenly capital adequacies. So somebody's gone out and said this 35,000 should have been, or 25,000 should have been 35,000. I don't think it's the number. The government's very clearly said they're standing by PSU banks. Once you say, if the top 2-3 banks say we don't need capital, which I dare say they'll be able to say, the next thing will be this 25,000 itself may not be required.
Of course.
On the other hand, there will be one or two chronic sort of borrowers who will need money, but I don't think the government is going to go out there and say, we'll just give you money so you can continue doing what you did earlier. Go after recoveries, because today, remember one thing, these are asset backed. If power plants have not completed, it doesn't mean there's no power plant. It means that it will be sold at a particular price, and there are rights of recompense in all agreements that are coming through. The new guidelines on SDRs, the strategic debt restructuring, or the restructuring of which banks are going through, which accounts are going through, indicates there's a right of recompense. A big new introduction in the SDR has been promoter, the personal guarantees, which was not addressed earlier, which says that even if the account is restructured, the personal guarantees will not drop off. So I think there is a lot happening, and I think we should not underestimate the power of the social media in terms of putting the pressure along with the regulatory pressure on some of these borrowers.
Okay, so you're happy to buy banks for a trading bet or for an investment bet?
Investment bet.
2 to 3 years, you're happy to own the large cap PSU banks?
Would it surprise me to see the top 2-3 banks double in value over the next 12-18 months? Everybody knows the problem. Does anybody know the upside? No. Next 18 months, if some of these banks went up 50 to 100%, wouldn't surprise me.
Okay. What about other legs of the economy?
Okay, other legs of the economy. Let me say, for instance, things like the auto space, for instance. I think the auto space, if you see the most recent numbers, I think it's revealing some serious revival. I think the problem has been we've tended to see this on a month-to-month basis. Just take a little longer perspective. I think there is an export market which all these people are exploring, and some plays like Tata Motors, for instance, have got an international leg which is larger than the domestic leg. But whether the recovery in the MCV, HCV space, or the recovery in the auto numbers, some of the traditional ones like Maruti, etc., continue to grow, maybe not month on month as much as we'd like. I think the auto revival will gather steam as more money goes to the rural space. That's very, very clear, and that will be true for tractors. It will be true for some of the farm equipment, etc. So there is a revival which I think the rural and the agrarian spending will indicate. Number two, I also believe that the various smaller players, for instance, ITC used to be the most beaten space. And I want to make a disclosure that these given as examples are not to market a stock, but I may
just to illustrate something.
Yeah, no, and I might be holding some of these as positions, so it's not to market, but just ITC. The only thing we can continue to see was the kind of exposure it had, to budgets and the regulatory impact on, and the fact that people are now recommending because the excise hit was not as much. But what ITC has done over a period of time is kept reducing its dependence on tobacco. It's moved into the consumer space. It's there in hotels, and a whole bunch of steps it has taken makes it really able to take advantage of the rural, the e-chopal and the move into the sort of the agrarian space. I think it will surprise you the kind of earnings push that can give.
Very strong return on equity business.
Very strong return. It throws out cash, continues to throw out cash. So you actually now are saying that for the next leg of the market rally, and I believe a new bull market in a sense may have emerged, if you believe that the correction is over, which I strongly do,
feel.
that, could it be stocks like a Tata Motors? Because every market has a new kind of this thing.
New leadership has to come.
New
from
leadership.
somewhere.
Whoever thought ITs could be a new leader, and I think it's a very real possibility. Could PSU banks? I think PSU banks could be. So there are new leaders emerging, and I think along with that, the big sector in the market, pharma, for instance, I think that the pharma space continues to be what the IT space was through the 90s and the 2000s. I think it is the pharma space right now, and there's been this over scrutiny, if you will, on 483s and FDA approvals. But if you assume those are speed breakers on a highway, you will continue to believe that pharma companies will become stronger in their governance and in their internal processes. Not that everything will get passed, but the fact that FDA is spending the kind of time on the Indian pharma space tells you the importance that this is. And I really believe the generics are here to capture the world. The sort of de-rating of stocks like Valiant in the international market indicates to me that gone are the days of profiteering even there. The move to generics is there to stay.
It's real.
And I think the kind of work that a lot of the frontline Indian companies, without naming any specifically, but all companies, the 30,000 crore plus market cap, there are at least 7 or 8 of them, I think would easily over the next 5 years be 2 to 2.5 times from here.
Okay, Jix, we're completely running out of time, but let's summarize our today's interaction. Your broad view is that we have a durable bottom in place.
We have a durable bottom.
Economy is chugging along.
Yeah.
Markets are not talking about good things which are happening, and we're only focusing on the bad things.
Sure.
PSU banks is a big call.
PSU banks is one big call. The other thing, of course, will be pockets, which is the mid-cap space.
So give me one more big call before we wrap.
I think one of the ministries that's done yeoman service in the last 2 years has been roads and ports. So anything to do with road services, port services, things like dredging, things like, as I said, in this space, which has been ignored spaces. You'll have to go out there and start looking for stocks.
So look at some of these bombed out names. I mean, that's where the opportunity is.
More than bombed out, ignored names. They may not be bombed out, they may be ignored. And I think you have to continue. I think mid-caps selectively under-invested, under-owned will do extremely well.
Life has sell greed. There is only fear right now. Appreciate your time and good to have you back.
Thank you.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.